Good morning. Thanks for joining us after the morning tea break. We're now going to turn our attention to a piece of research that the ASF commissioned earlier this year. And it's my great pleasure to welcome Professor Ian Harper, who will present the findings and explain the research that we conducted with the industry over the last 5 months. The Australian Securitisation Forum has focused since the financial crisis on the state of the domestic investor market for asset-backed and mortgage-backed securities, and with various things that are going on around the world, is keen to be part of the discussion in the Australian market on matters that can be addressed to make the Australian bond market and the allocation to fixed income as an asset class greater. Ian Harper was commissioned as part of the Day2 Access Economics team to work with the ASF on this piece of research. Ian will explain the background and how we went about that. But Ian, again, is a person that doesn't need a great deal of introduction. He is extremely well known, one of Australia's best known economists. He's had a career working within academia with governments, and now as part of a professional services firm, Day2 Access Economics. Since leaving the world of academia in 2008, he has worked as a director with Day2 Access Economics. Prior to that, he had a long period with the Melbourne University and the Melbourne Business School. He also had a role in 2005 to 2009 serving as the inaugural chairman of the Australian Fair Pay Commission. He is well sought for his views and as welcomed as a commentator in various forums. So I'd now like to welcome Ian Harper to the podium to talk about the research project.
Well, thanks very much, Chris. I appreciate the welcome, ladies and gentlemen. As Chris has just said, what I'd like to do in the next 20 minutes or so is to give you an overview of the report which the Australian Securitisation Forum commissioned from my colleagues and I at Day2 Access Economics. I won't say that they commissioned it and just then set us free. That's not how this one worked. The ASF set up a steering committee with whom we worked. And I might just take a moment here, Chris, to thank you and the colleagues on the steering committee. This is an area which people in this audience would know is full of technical detail and where a lot of practitioner perspective needs to be brought to bear. We don't necessarily have that, or certainly I don't, within Day2 Access Economics. So it was terrific to be able to get the perspective and the input to test ideas and to have people from the industry scud about and dig up some data and test ideas at one remove as well from us. So I thought it was an excellent process. It was a terrific way of us putting together a report which I hope you will see combines the elements, if you like, of the overview the economist can bring and the principle that I'll outline in a moment with the detail and practical insight that comes from the involvement of industry practitioners. We called it Out on a Limb, and that in fact was a suggestion from one of the members of the steering committee. We called it that because Australia is an outlier. When you start thinking about the domestic fixed income market, you pretty quickly come across two features of Australia that set us apart from the rest of the world. The first is that we have a comparatively low level of corporate debt outstanding, securitised corporate debt. Most corporates rely on the Australian banking system, and for good reason. But what that means is that we have a small domestic bond market by comparison with other countries. I'll show you a chart in a minute. Now, those corporates who do rely on corporate debt issues tend to issue outside Australia. So if you like, we get caught on both fronts. Those who are large enough or inclined enough to be able to go across to the international markets, then they issue their debt internationally. And those, and not exclusively, in fact, other companies, of course, who issue overseas still rely significantly on the input of domestic banks, but those who don't go overseas, aren't large enough, don't have an inclination, will rely more on the domestic banking system for their credit needs. So those two things together tend to make us have a small domestic bond market. The second feature which isolates Australia from our peer countries is the fact that when it comes to fixed income asset allocation within the superannuation funds, it's clear that the allocation to fixed income assets in Australia is low compared with other developed countries. I mean, quite markedly low. Again, I'll show you a chart in a moment which backs this up. Even within the category of fixed income assets where our exposure is low, we have a low exposure to domestic fixed income assets. So in other words, if you broaden the category out and say, oh, well, that's just because there isn't a domestic bond market. No, no, no. Even if you think about fixed income globally, the allocation of Australian superannuation funds to fixed income assets is low by comparison with our peer countries. We have high equity, high exposure to cash, and a low allocation to fixed income assets. In the report, we describe the situation as a low equilibrium, low demand and low supply. And part of the reason for using that concept, of course the report's written by economists, but apart from that, it gives you the idea, we hope, that there is a mutual support between low demand and low supply. Some people describe it as a chicken and egg problem. Part of the reason that there is low supply of fixed income assets into the domestic market is that there's low demand. And part of the reason there's low demand is there's low supply. And you know that a market can sit in that equilibrium, sometimes suboptimally, and that's what brings us to the point of the report, sometimes suboptimally. In other words, everyone would actually like the system to move away to a higher equilibrium where there was higher demand and higher supply, but the thing is locked. It's locked into low supply, low demand, and it has to be shoved or nudged or pushed in order for it to move. There's been a lot of discussion about why Australia has no corporate bond market to speak of. This isn't a new issue. And a lot of frustration about even policies which have been tried over the years having had no discernible result. Why is this? Part of the reason we contend in this paper is that it is a low equilibrium. In other words, there are mutually reinforcing factors which keep you where you are, even if you want to go away from there. So how could you move from a low equilibrium to a high equilibrium? That's the issue that this paper contemplates. Well, does it matter? Why would you bother? Is there a problem here? The paper also talks about that, and I'll give you some high-level arguments in a moment. So, there's the nature of the issue. We're in a low equilibrium with respect to fixed income assets. Low supply, low demand. Does it matter? And if you thought that it did, are there cost-effective, practical policies that could nudge the system, push the system towards a high demand, high equilibrium, which would then become self-sustaining in its own right? Is that possible? Is it timely? That's what the report looks at. First, a couple of charts. Here's the chart I promised you about corporate debt, and you can see us there on the left. This is simply corporate debt outstanding as a proportion of GDP. Anyway, it's a matter of common knowledge that we have a low corporate bond market, a small corporate bond market here. Here's a slightly busier chart, one that's a bit harder to look at, but you'll see us right up the top there on the left, just underneath Korea. And the bar to look at is that dark blue bar, which represents the proportion of pension fund allocations that are allocated to bills and bonds. And then you can see as you pass your eye from the left of the chart across to the right of the chart, you pass through the other categories there: equities, cash and deposits, and other. Well, notice the two things. Firstly, of all of those countries listed there, just take the average, which is roughly in the middle of the chart, obviously, you can see that we have a very low allocation to bills and bonds, to fixed income assets, compared with a raft of countries, many of whom are developed, some of them whom you might regard as not developed countries, but we're at the very low end. Now, even if you select out from that large list of countries those countries that also have significant exposure to equity. So you might say, oh, well, that's because we have a big exposure to equities. Obviously, the flip side of that is that we have a low exposure to fixed income. Well, hang on a second. Look at a couple of countries, the United States, the United Kingdom, just underneath where we are. They also have asset exposure or allocation to equities, which is not that different from us. And even compared with them, we're low. So there's no doubt that we have a low allocation to fixed income assets within our superannuation funds. And as I mentioned a moment ago, we have a small corporate bond market. Low demand, low supply. Are these things connected? Well, the report argues that at the very least, they support one another. They are mutually supportive. So if you find yourself in this situation, which we're in, and we're miles away from where other countries are, you might want to ask, why? Now, there are various explanations that the report goes into, things that people come up with, like, for example, we have a defined contribution superannuation scheme. Well, most of our superannuation schemes are defined contribution rather than defined benefit. Maybe that's the answer. You can fairly quickly dismiss those sorts of explanations because there are lots of countries that have defined contribution superannuation as the bulk of their superannuation schemes, and yet they have an allocation to fixed income that's much higher than us. Oh, well, maybe it's because we have a relatively young population and therefore they're still in the accumulation phase. Our population on an age basis is roughly in the middle of the OECD. We're average. An average age distribution, or average age of the population here, not much different from the average in the OECD. And yet we have a very different allocation to fixed income. So you'll find the report goes through these things, and most of them, there isn't any obvious simple explanation, apart from the fact that low demand and low supply characterise our circumstances, and they are mutually supporting, which is why we describe the situation as a low equilibrium. Well, who cares? Why is this a problem? As far as the small domestic bond market is concerned, one thing that could be an issue, and you heard Ken Henry talking about this earlier this morning, the IMF also worries about this, is Australia's exposure to the international capital market. We're a country which has a chronic difference between national investment and national saving. That's a good thing by and large. It means we're growing. Lots of good investments for people overseas to take a piece of. Thank goodness that they do. That helps keep Australian living standards rising. But it means that we are exposed, therefore, to the vicissitudes, to the dislocations, to the dysfunction that can arise in international capital markets from time to time. The absence of a domestic bond market essentially means that we can be exposed on both sides. Australians invest offshore and are therefore exposed to what happens, and borrow from offshore. Some people have been unkind enough to describe Australia as a country as a large margin lender. We borrow and then we invest in equities elsewhere in the world, just like a margin lending scheme. Well, even though that might be slightly tongue-in-cheek, it ought to raise your alarm bells. You might think, well, hang on a second, that could be a pretty risky situation to be in, to borrow all this money from these guys and then invest in equities. Answer, yes. The Japanese are a nice counterexample. They borrow a whole lot more than we do, particularly, of course, to finance the government in Japan. And yet a lot of that is financed domestically. So notwithstanding the far greater indebtedness of the Japanese government, the Japanese economy has been much less affected by dislocation in the international capital markets because of the domestic investment that's funding the domestic borrowing. We would argue in the paper that a domestic bond market is a better solution to dealing with the dislocation that can arise in these markets than having a Commonwealth government guarantee. Exposing the taxpayers in the way that we had to through the GFC is an expensive and risky business compared to mobilising the domestic savings on a more regular basis. And of course there are simple economies of scale and scope that we miss out on because one piece of our financial market is underdeveloped, is atrophied, shrunk. There are scale economies that come from operating that market on a larger scale, and of course scope economies in being able to use fixed income along with other asset classes and to be able to borrow using that market as well as other instruments domestically and offshore. What about the low allocation to fixed income assets? This one's a bit trickier. What we discovered when we got the groups together was that there were really, and this is simplifying a complex issue, I concede that, two broad views that centre on longevity risk and sequence risk. There are people who think, of course we're exposed to equity, you want to be exposed to equity. Life expectancy keeps increasing. Nobody knows how much life expectancy will continue to increase, even though people have retired, as Ken said before, they could have 20 or 30 years to live. Obviously, in those circumstances, it is responsible to manage longevity risk to have a significant exposure to equities well into your retirement years. And the opposing view, of course, is sequence risk. Well, average returns on equity are higher, that's true. But what matters for people's living standards, for their ability to be able to fund their retirement, is the sequence in which these returns arrive, not just their average. And if you happen to get a bad draw leading up to retirement or early in retirement, then your living standards could be severely adversely affected by excessive exposure. And so you ought to be thinking about age phasing your asset allocation into retirement, which is sort of a long-handed way of saying you ought to be reducing your exposure to equities and increasing your exposure to fixed income. Well, be that as it may, we don't actually adjudicate that issue because there's a lot in there that's quite complex. But it would be a worry. It would be a worry if the reason we have such an exposure to equities, in other words, we are such an outlier in this, if the reason had nothing to do with an abstruse debate between longevity risk and sequence risk, nothing to do with that at all, but was simply the outcome of behavioural factors, path dependency, hysteresis, the fact that the system has built into it a memory which it lurches back to whenever it's kicked away. And path dependency. We're here now because we started there. Why did we start there? Well, that's lost in the mists of time. But we're here now because we started there. If we'd started somewhere else, we'd be in a different place. If I wanted to get to Dublin, then I wouldn't start from here. Well, we did start from there. Well, that's why we're not going to get to Dublin. In other words, path dependencies and behavioural factors, are they at play? And in any case, oughtn't you be concerned that we are so far out on a limb, particularly in respect to the low allocation to fixed income assets, that prima facie there is something happening here that we need to understand? Well, the report, as I say, doesn't adjudicate the longevity sequence risk. We do talk about something which is changing the balance of that, and I'll come to that in a moment. And we do talk about some behavioural factors that may explain why we're at, that have got nothing to do with anything more complicated than incentives and history, inertia. And if that's the case, we need to be concerned. It's as if we've drifted into this. It's a self-fulfilling equilibrium, and we're busily working away at it and nobody's given it any more thought than that. If that's the case, then there is a problem. Here's a graphic. You'll see that we like to think summarises what the report is actually saying. On the left-hand side, you can see our low equilibrium characterised there, low demand, low supply, and the factors which the report argues essentially support that or sustain it. And then there's a high equilibrium on the other side with high demand, high supply, and some other things that you'd expect to support that sort of equilibrium. Now, the essence of the report says this. There are two types of change, forces for change, demographics and regulation. Which, if you like, have loosened the low equilibrium of its foundations. They have created movement at the station. They have created the potential for us to move this equilibrium. But that's all. If you like, these factors have slipped underneath the low equilibrium some rollers. And the low equilibrium could be rolled towards a high equilibrium because of the advent of these forces for change. But they probably wouldn't drift there by itself. Because the low equilibrium is so self-sustaining, it needs some additional policy intervention in order to give it that nudge or shove. But the nudge or shove is timely now because the system is more easily moved than it might otherwise be because of the demographic and regulatory forces for change that are present. That's it in a nutshell. That's the argument. Well, as I said, we set up 4 working groups through the good offices of the Australian Securitisation Forum, and each of those working groups consisted of industry professionals, practitioners, who then went off to address a number of these questions that we'd asked them. Issuance and market features, what factors limit supply. There was a survey of corporate treasurers that was undertaken by the Finance and Treasury Association. Fees, allocation and distribution, financial literacy, tax and regulation, you can see that for yourselves. So I'd want to assure you that there has been significant practical input to this. And now, of course, that doesn't mean that any one of those people signs up to the final result and thinks that's absolutely what they think, or that you would agree with everything that's written there either. But I just wanted to give you that assurance that this isn't a bunch of economists dreaming about this in the bathtub. There have, in fact, been quite practical inputs to this process. Now, I mentioned the 2 forces for change. What we're talking about is this. On the demographic front, even though it's true that the population, the average age of Australia's population is about the same as that elsewhere in the OECD on average, it's nevertheless true that there is a wave of the baby boomers who are moving in to retirement, or at least moving into the pension drawdown phase over the next decade or so. Now, whatever your view of longevity risk or sequence risk, in other words, whatever you think the proper advice to give to a retiring, soon-to-retire baby boomer like me is, well, Ian, you could live for 40 years. You do not, therefore, reduce your exposure to equities. Or, well, Ian, you ought to better be thinking about moving in to fixed income now, and your fixed income allocation ought to be your age less X%. Whatever your view about that is, our point is simply this. The movement of this wave into retirement will bring this issue to the fore. It will mean that people like me are thinking more carefully about that problem. And therefore it gives us the incentive, potentially, to reallocate our assets, whichever side of that debate you're on. So if I'm having the same voices put to me as I've had for years about longevity risk versus sequence risk, I will be listening more than I've been listening before, and I will be in the same boat as large numbers of retiring baby boomers. Super funds will have more members in the pension drawdown phase. That's the same story. And of course, all of that, as I say, sharpens the focus. So demographics matter. Regulation matters. All of the new rules that are coming in, about which you heard a good deal yesterday, and Basel III, well, yes, there's a bit of a debate about what the impact of Basel III will be. In the report, we say that it will have 2 effects on the banking system. One is that it will induce the banks to increase their demand for liquid assets and potentially increase the demand for high-quality corporate bonds. Charles talked a bit about that yesterday. And on the other side, we expect that Basel III will stimulate some disintermediation, that is to say, it will give impetus to the originate-to-distribute securitisation model. Now, okay, it's contentious. Charles thinks there's no more than 10 basis points in this. Well, we'll see. Certainly my mates in the banking system, of which there are a number here, contest that. Put it this way, Basel III is intended to make intermediation more expensive and less risky. It is therefore highly likely that financial activity will find its way out of the intermediated sector into the non-intermediated sector. You may well ask whether that is self-defeating on the part of Basel III, given that's where the GFC started. Well, that's another debate. But if it's true, it will stimulate the growth of supply in the fixed income markets as well as demand. And of course there's MySuper, which will also focus attention on the asset allocation of superannuation funds, particularly from the baby boomers who are getting closer to retirement. So those things there are forces for change. As I've said, I don't think they guarantee that there would be a migration from a low equilibrium to a high equilibrium. I don't think that, and the report doesn't say that. But what the report says is that those two things, demographics and regulation, will lift it off its foundations. They give us a reason to think again. And with appropriate policies put in place, you might just create a movement in the other direction. So what are the policy options that the report canvasses? These things that could take the system from a low equilibrium to a high equilibrium, given that it's been, as I say, shoved off its foundations by these developments. The first is to eliminate competitive biases against fixed income assets, and there are a number of those that are canvassed in the report. Obviously, the financial claims scheme, which applies to term deposits amongst others, is something for which the holder of the deposit does not pay, let alone the issuer of the deposit, and that creates a non-neutrality between those fixed income assets that are supported by the financial claims scheme and those that are not. A number of our regulators, including the Governor of the Reserve Bank, has been talking about that, and I think it's a good idea. The report supports that. There's also the issue of the so-called too big to fail institutions, or DSIFIs as they're known in the lingo, domestic systemically important financial institutions. It is true, as John Laker has been saying, that APRA is considering exactly how much additional capital to require of DSIFIs, as APRA is obliged to do by Basel III. Well, if you make that calibration correct, then you will eliminate the advantage that the too big to fail institutions have relative to other borrowers. That's true. That's true. They can borrow more cheaply because people think the government stands behind them. Charge them more capital and you will neutralise the impact of that on their cost of capital and all as well. You better make sure you get that calculation right. So that needs to be thought about. We heard a lot about adverse fee incentives in portfolio management. On closer inspection, we really couldn't sort that out. There were some things that went one way, some things that went the other way. There are some numbers in the report you can take a look at. Make up your mind yourselves. We say here, investigate it. If there are adverse fee incentives that favour issuing, advising, managing equities over against debt, then they need to be dealt with. But suffice to say, we couldn't find immediate evidence for that, not clear anyway. We did find evidence and considerable argument about incentives or even just historical precedent applying to portfolio management as opposed to asset management. And the argument was put to us that there's a lot of focus on asset class management in our system and nowhere near as much focus on portfolio management, allocating assets across classes as opposed to within classes, and that we'd sort of fallen into this over the years. And that the degree of expertise and specialisation we've developed is within asset classes rather than across asset classes. And therefore it might make sense for us, beginning with the default superannuation schemes, to start talking about absolute return objectives like CPI plus X%, and encouraging the system to think at that level, open up the issue of asset allocation across classes without diminishing the expertise that we have within class. Start with the default schemes, see if it becomes a trend. And allow mutuals to access stranded franking credits. That's a particular issue for mutuals, which of course don't issue shares. They own or receive franking credits. Those franking credits are locked up and unable to be passed through to shareholders because there are none. Is there a way in which they could be passed through to bondholders, which would give the mutuals greater access to funding and make the mutuals a more potent source of competition for the shareholder-listed ADIs? Improve access to the fixed income markets. ASIC has done quite a bit of work on this already, and there is some legislation which is pending. But there's a $50 million limit in there on the access to simplified retail prospectuses for debt issues. The basic issue is that without that, issuers of debt have to provide documentation to investors which is as extensive as an IPO. It's not just that that's expensive to do from the issuer's point of view. When the investor gets it, the investor thinks, there's something wrong here. This must be terribly risky. I want nothing to do with it. Well, to be fair, ASIC has recognised that, said, OK, if you're over $50 million issue, you can have a simplified prospectus. Well, that's terrific, but most of those guys are big enough to go offshore anyway. And the ones who are under 50 million are uninvested on the same box. And anyway, does it make sense to have our bond market such as it is, biased towards those issues under 50 that might be by their nature a bit riskier? Does it help? There's other things being done there about expediting proposed reforms for disclosure and liability requirements, which we simply endorse. It's important that we improve access to fixed income markets. We should be thinking about how to develop the infrastructure to facilitate the market for fixed income assets. We recommend in the report taking a close look at the LSE's order book for retail bonds and pursuing the listing of bonds on the ASX, which Elmer Funkakupi has been talking about as well. Education of investors is an issue which came up. Perhaps an online central repository for debt instruments offering circulars and prospectuses in one location would be a good idea. But others have observed that on the nightly news, you get a rundown about what's happened on the stock market. Alan Kohler, if you're watching the ABC, does a terrific job. But does Alan ever talk about the bond markets? Well, it's not Alan's fault. But it helps to reinforce this idea that the stock market is what you should be investing in, there isn't anything else. Some greater education, particularly enlisting the support of the industry itself, we recommend. And that education might include financial advisors and planners. We shouldn't leap to the conclusion that they are completely au fait with fixed income assets as well. And finally, the report argues for the encouragement and support of developments to develop new and niche products. We list a few there: the municipal bond market. I grew up in Brisbane. I can well remember advertisements on a Friday night featuring the late Clem Jones as he was spruiking Brisbane City Council bonds. So there's some precedent for this. A municipal bond market in the United States looks very different from what it might look like here because of our own federation, but we should think about that as a possibility. Deepening the annuities market, which again we heard Ken talk about this morning, for reasons partly to do with the demographic changes and partly to do with stimulating demand and supply for bonds. And finally, a wider range of securitized trusts, coming back to the issue of master trusts, that introducing master trusts and facilitating that would help particular classes of authorised deposit-taking institution issue securitized products. So there's a set of policy options that you'll see talked about in the paper. Those policy options are intended to overlay these forces for change which we describe. And the report recommends that they be adopted if you want to move from the low equilibrium to a high equilibrium. In the high equilibrium, we should have demand and supply supporting each other to sustain that outcome in much the same way as they currently sustain a low equilibrium outcome. Thank you, Chris.